Welcome to the Deep Dive. Today, we are digging into the Q3 2025 earnings call for Ibotta. That's ticker IBTA. The call was on November 12th after the close. And if you were watching the tape that day, you saw it. A massive single-day drawdown.
Yeah, and that's the real puzzle here, isn't it? It was a fascinating, if painful quarter for investors. Ibotta actually delivered beats on some key metrics.
They did.
But the market just did not care. It completely ignored the historical numbers and just fixated on the trajectory on the future.
It felt like management's whole story about this long-term strategic transformation just ran into a brick wall, a brutal reality check in the form of guidance.
And cost compression. Frighteningly compressed margins.
Right. So our mission today is to really unpack how a company like this, a growth company, can technically beat expectations and still lose, almost a quarter of its value overnight?
It all comes down to a structural pivot that's proving to be a lot more costly and disruptive than anyone thought.
Okay, let's start with the headline numbers, the snapshot.
So we have to start with this mixed reality. Revenue, it came in at $83.3 million.
Which was a beat. A modest one, but still a beat against consensus, which was sitting just under 82 million.
It was a beat, but that's pretty much where the good news stops, at least on the surface.
And here's the problem, and it's an immediate one for anyone looking for growth. That $83 million represents a really severe 16% decline year over year.
16%. I mean, for a company that came to market as this innovative growth platform, that kind of deceleration it's just a huge red flag.
A massive one. What about profitability?
Well, the numbers there were messy. GAAP diluted EPS was 5 cents, which, that did clear the street's near zero expectation.
Okay.
But the adjusted diluted EPS was 56 cents. And this number created some confusion. It comfortably beat one of the lower consensus estimates, which was around 34 cents.
But missed others.
But it reportedly missed some of the higher sell-side estimates, which were up around 77 cents. So the initial narrative was a bit conflicted, but the underlying margin story, that was crystal clear.
And that's the real story, isn't it? The cost of doing business for them just skyrocketed. The operating margin compression was, it was really severe.
Severe is exactly the right word. Operating margin came in at just 2.8% for the quarter.
2.8.
Yeah. And just think, that's down from 21% in Q3 of last year.
Wow.
Now, they did report that the adjusted EBITDA margin held up okay at 20%. But that's a function of a lot of non-GAAP adjustments. The fact that the core operating margin just collapsed. It tells you everything about how much the cost structure has intensified.
Okay, let's unpack that a little. That 16% revenue decline, where exactly is that coming from?
So the engine of the business, redemption revenue, fell 15% year over year to $72.1 million. But you have to look at the split. That's what's crucial.
Right, the structural split between their own app and the network.
Exactly. The direct-to-consumer, DTC, redemptions. Historically, their higher margin channel, they just got crushed. Down 34% year over year.
34, wow.
Yeah. But in contrast, the third-party publisher redemptions, so that's the new IPN integrations, they only declined about 6%.
So you're seeing this clear migration of activity. They're building out the Ibotta Performance Network, the IPN, but it is coming directly at the expense of that higher margin legacy business.
And that trade-off, that exchange, is just inherently dilutive to revenue in the short term. And it creates what we're calling the operating paradox.
What do you mean by that?
Well, management was quick to point out that their total IPN redeemers, so the number of users, actually grew a healthy 19% year over year.
Which is a good thing. That's the new integrations working, right? Instacart, DoorDash.
Exactly. It's a testament to those big partnerships paying off. They're definitely increasing their reach.
But the paradox is that this massive new reach isn't translating into, dense usage?
Precisely. Despite 19% more people in the network, total redemptions still fell 15%, which means redemptions per user, the key efficiency metric, it dropped a staggering 28%.
So they're getting new, less engaged users through partnerships and losing their stickier, higher value users from their own app.
That is the direct, painful link to the revenue struggle. It fundamentally pressures their whole monetization model.
Before we dig into the strategy behind all this, we should probably touch on the balance sheet. They're not bleeding cash, are they?
No, not at all. They've got the balance sheet to manage this. They generated $10.6 million in free cash flow this quarter.
Which is still a margin of almost 13%.
Right. Now that's down sharply from over 37% last year, which again shows you how expensive this transition is.
Yeah.
But they're still generating cash, and they have a healthy position. Reported $223 million in the bank.
And crucially, capital return. Management spent $38.7 million buying back 1.4 million shares.
And they did it at an average price of $26.73.
That number, we need to remember that number. It's going to be a really important anchor when we talk about the stock later on.
It's a huge signal of their own conviction, even as they're deliberately trading away that short-term growth, which, it raises the big question.
Yeah.
What challenges, internal and external, made this transition so painful this quarter?
Well, they pointed to a couple of big external pressures. They cited ongoing macro uncertainty, the University of Michigan Consumer Sentiment Index being near historic lows.
Sure.
And this is critical for their CPG clients. They mentioned the disruption to U.S. SNAP benefits. That's causing a lot of brands to just trim or delay promotional spend.
A real wait-and-see approach. Yeah. And on top of that, you have to account for the internal stuff. The organizational friction.
The sales reorg.
Yeah, they completed a major sales reorganization, shifting from territory-based to industry-based coverage. Management admitted it caused near-term disruption, turnover, account handoffs.
Yeah.
It definitely hit the Q3 numbers hard.
Okay, so this is where it gets really interesting, because all this pain is tied to their big strategic pivot. The entire future of Ibotta is being bet on independent measurement.
Right. They're trying to position themselves for what they call the outcomes era of CPG marketing. The challenge is skepticism.
For years, they've been seen as just a coupon engine.
Exactly. And to get that premium ad tech multiple, they need clients to really trust that they are driving incremental sales, not just, subsidizing sales that would have happened anyway.
The old problem of grading your own homework.
Which is precisely why that Circana partnership they announced in September is such a potential game changer. It lets clients get independent lift studies from a trusted third party.
And they're putting their money where their mouth is. They're funding millions of dollars worth of these studies themselves.
Yes, they are. They are essentially investing their own capital to de-risk the testing phase for these huge CPG clients trying to unlock those massive traditional ad budgets.
And this all ties into their new product, LiveLift, the AI tool for in-flight measurement.
Right. It's designed to give that precise, real-time optimization that's been missing from the CPG world.
And the initial results there sound pretty good.
They're promising. An 83% pilot renewal rate is what they quoted. They share some testimonials, like the liquid death example, showing it can drive sales more precisely. That renewal rate is the proof of concept.
But the adoption timeline, that's the painful reality check, isn't it?
It is. Management was really careful to stress this will be gradual. Big brands, they need time to test, to do the Circana studies, get through budget cycles, and then finally reallocate.
So even though the CEO said they're on track for 20 LiveLift pilots before year end, which is a good acceleration, it's still just a drop in the bucket.
The drop in the bucket. And the market's impatience with that timeline just completely crystallized around the Q4 guidance.
Which is the gut punch.
That was the gut punch that triggered the drawdown. Q4 revenue guidance, $80 to $85 million. The midpoint implies another 16% decline year over year.
And it lands about 2% below what the street was expecting. The margin guidance was weak too.
Very weak. Adjusted EBITDA of $9 to $12 million. That midpoint of $10.5 million is only a 13% margin for Q4.
And why is it so low?
It's deliberate. It's the investment strategy. You've got the seasonal marketing ramp up, the fully staffed sales teams, and crucially, that big upfront investment in those Circana lift studies. They're spending millions now for a payoff later.
Which sets up their whole theme for 2026, which they called Make It Easy.
Yeah, they're basically admitting that LiveLift, while powerful, has too much friction right now. The whole focus is on streamlining the setup and reporting to make it easier for CPGs to shift those huge budgets over.
So if you connect all these dots, the market's reaction, it wasn't just about the Q4 guide. It was about the whole trajectory, the repeated disappointment.
And the volatility. The market is just tired of the promises and wants proof.
The price action tells the whole story. The stock closed at $32.73 before the call.
And the next day, it closed at $24.98. A 23.7% drop on massive volume.
And this isn't new for them. This is a pattern.
A painful one. Q4 last year, Q2 this year. Both saw 30 to 40% single-day drops on guidance. Over the last year, IBTA is down almost 70%, while the S&P is up over 17%. The market is completely re-rating this stock.
And the sell-side analysts have followed suit.
Oh yeah, the consensus is basically reduce. B of A, Goldman, they reiterated sell ratings. Even Needham, who was a bull, they kept their buy rating but slashed their price target from $70 all the way down to $33.
A huge reset.
It's a unified message. Management is saying, we're positioning for the future, for the outcomes era. And the market is saying, prove the top line can stabilize first. We don't care about the story until the bleeding stops.
Which is a staggering punishment. So we move now to our segment where we discuss the outrageous but plausible trade idea for the week. And just a reminder, this is for informational and entertainment purposes only. It is absolutely not financial advice.
Okay, so the IBTA print was obviously painful, but the company's capital structure, combined with management's own actions, it offers a really unique volatility play right here.
Okay, I'm listening.
We just talked about it. Management spent $38.7 million buying back shares at an average price of $26.73.
Right, and the stock is now trading well below that.
Significantly below.
Yeah.
And the consensus 12-month price target still sits around $33. That's 35 to 40% upside if this pivot actually works.
So if the strategic risk feels too high for just buying the stock outright, how do you structure this?
The trade is to go long IBTA stock, but with a twist. You're explicitly betting on that buyback program, creating a stabilization zone around that $26, $27 level.
Okay.
But given the insane volatility, that average earnings swing is almost 24%, you finance this long position by selling an out-of-the-money call option, maybe target a strike price up around that $33 analyst target.
So you sell the call, you collect that premium, and that lowers your effective cost on the stock you bought.
Exactly. You are essentially selling the high volatility that the market is pricing in. You generate some yield, and you minimize your exposure to another catastrophic drop, all while betting that the buyback creates a psychological floor.
It's a trade designed to capture a potential stabilization while you monetize the market's fear.
That's it. You're betting on the long-term success, but you're hedging against the market's extreme impatience.
So today we've looked at IBTA's Q3 deep dive. It's really a study in strategic ambition meeting just brutal market impatience. The numbers showed this clear structural pivot to a measurement-centric model.
Yep, with LiveLift and Circana. But the price of that transition was steep. Shrinking revenue, compressed margins, and it was all amplified by macro headwinds and that internal sales friction.
The core question for the long term, it really remains whether management can convert this expanding network and these new tools into a real premium share of CPG marketing budgets.
And fundamentally change their identity from, a coupon app to a durable ad tech platform that deserves a much higher valuation.
So we'll leave you with this final provocative thought. Management anticipates that this revenue decline, maybe low double digits, will persist from Q4 into Q1 of next year before they expect to see sequential growth. So the question is, what specific data point would constitute actual proof in Q1 or Q2 next year that this make it easy theme is finally starting to work? What would prove the pivot is outweighing the headwinds and allow the stock to finally stabilize near, or dare we say, above that $26.73 management buyback price?
That is the multi-million-dollar question.
Thank you for joining us for the deep dive.